Okay. All right. Here we are. 0 days to expiration, and this is the final hour. Cool. It was one of those days where you expected a lot more. I really expected things to take off. I mean, Goldman Sachs said we were going to the moon, right? But it didn't work out that way. The the market made a little bit of an advance on bad news, of course, and of course that means that we are in opposite world. What is opposite world? Opposite world is this narrative that is developed around what the Fed does. Now, the market itself is always looking at the Fed as a forward pricing mechanism. They are looking at what the Fed's future value of money should be. And of course, they make all the decisions based on what they think the Fed is going to price the future value of money. And in this case, everyone is expecting, there is this narrative going around right now, and it is that they're expecting the Fed to pivot. Now, what is a pivot? A pivot means that they're going to do what they're not doing right now. And what they're doing right now, apparently, is quantitative tightening. They are in this process of hiking interest rates and trying to slow down this economy, which there's a kind of a disconnect there. You mean the economy isn't slowed down? It's really heated up. Is that what's really going on? They would like to reduce employment because if you reduce employment, then there's less economic activity. Fewer people have less money to go after goods and services. Therefore, the theory goes that if there's less demand, there will be lower prices. Now, so anything that would give the market the idea that that is what is going to, or some economic activity or whatever it is that will bring us closer to that narrative, then that is bad, right? No, 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 that's good. Because if we can slow down the economy and not have as much of a need for interest or interest rate hikes, then that's good, right? Yes, except for right now, everyone thinks that the Fed is going to slow down their, or get things will get so bad that they will reverse everything that they're doing. All right, so that is the current narrative. If things get so bad, there's so much pressure on the Fed for their rate hikes and their tightening and all of the anguish and pain that Jerome Powell himself said he was going to deliver, gets so bad that they just can't take the heat. They cannot take it. And so they will do exactly what the Bank of England did, and that is pivot. Pivot means stop the rate hikes, stop all of that activity, and then go back to quantitative easing. Now, of course, we all know that's just ridiculous, right? Yet that's what the market believes. The market wants to believe that. I shouldn't say they believe. They want to believe that. So why did the market go up today? Well, the market went up on bad news. Bad news means more pressure on the Fed, more or greater chance that they're going to pivot. I know it is so convoluted. It's unbelievable. Let's see. The report that came out today was the housing home builders, and it's a forward-looking report, and it was much worse than expected. So that is basically saying that, hey, they're looking out ahead, and it looks like we're going to be building fewer homes, which means fewer people are going to be employed. I mean, obviously, the housing market employs a massive number of people and industry to put together homes, and it affects industry and materials and resources across the gamut. And it is contracting. It contracted way more than was expected. And so what did the market do? It went up. Because bad news, that's good. All right. So that's the situation we're in. Let's see. How much did it go up? It kind of took its sweet time today. It went up, and I think I'm going to go to the charts here in a second here, and I'll show you what's going on. Doot 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 doot. All right. And since the market opened, all right. So that now the interesting thing is that upon this news, the market went up. This happened prior to the market opening. So economic reports usually come out around 8 a.m. Eastern time, 8:30, right around there. And so this report came out and the market shot up a bit. And we thought it would reach into a zone that is kind of like the next stepping stone for the market to go even higher. Stayed around there for a little bit and then it just dropped. Bottom just dropped right out of it. Fell right down here. And then it had a sort of reprise, came back up, and then it's dropped again. All right, so I'm narrating all this, and you have to imagine what I'm saying. So let's go to the charts. All right, let's remove this guy here. It's a little bit too much information. Economic report came out right about here. Well, actually, look at that. So it started to go up. Are we looking at the same thing? Started to go up, and then it lost all its mojo. It looked like since the economic report came out right about here, things started to move up and into this zone, and then it gave it all back. What could that have been? Yeah, we dropped pretty hard here. Let's take a further out view of this and see what's going on. So we're definitely in what you would characterize a bull market rally. We came off the CPI numbers last week, really strong, and we've moved up into this area here. And there's this T1 is another, like I said, another stepping stone for the market to go up. If we can clear that, the market will likely rally. But it was stopped hard here. Interesting. So what does that mean for us? We're sort of stuck here in the middle between these two big nodes, T0 and T1. You can't see them at this level. You have to really go back to this level to see them. Let's see if we can bring them into view. There we go. All right, so it's this is a tight map here. Here's T1, here's T0. These two nodes right here. These are critical levels here. If we get down below here, we're going to fall a lot further. This is where the CPI went down, hit a bottom, and then shot back up. A lot of people are expecting us to continue to rise up through T1, through this next level here, which I'm going to call T2. T2, just so that we have something to refer it to. And much like this bear market rally, a lot of people are suspecting that I guess I was duped. I really thought that we were going to rally today. Man, I guess Goldman Sachs was wrong. Imagine that. Well, let's zoom in on again and see where we're at. Yeah, that really looked like we were going to take off. Now, yesterday, this is the overnight action. Yesterday, if you remember yesterday's show, we had a trade on that sat right about here, right there. And it looked like for sure we were coming up. Right at the market close, it stopped short. And then in the after hours, the market resumed. So I guess I was right, but just too early. And it would have been a perfect pin, but it wasn't. And so overnight, the market shot up here, two surges. Let's see, what time did this start? It started around 4 o'clock, 5 o'clock in the morning. Wow. Rose up right into the open. And then after the open, it dropped sharply. And now here we are here. Man, this is a confusing market. I think what we're seeing here is a level of consolidation that may be taking place between these two nodes, which is rather unusual. So it looks like our session, all the volume in the session happened right about here. All this volume, I think, happened in a previous session, so we can confirm that. What I'm trying to figure out is just where we're going, because this is really typical of bear market rallies and why they're so difficult to trade. And one of the reasons why I didn't even bother trading today, quite frankly, was because of these intraday reversals, which is typical, like I said, in a bear market rally. And so I had a lot of trouble with that in the past, and so I've basically sidestepped them. Now, didn't lose any money, just went sideways, and it was super frustrating because it's hard to pick a direction. We don't want to trade all day. We don't want to try to chase the market. We would like to have a fair level of confidence that the market's going to end up in a certain area, and then just place our trade. Keep our risk to reward, that asymmetry going. But in these markets, that's very difficult to do because you don't know, are we going to reverse once, twice, three times? We don't know. In this case today, we reversed once, twice, three times. So basically sat on the sidelines. Now it looks like the market is trying to drift down. We've gotten down as low as here. Could we be reaching for the T0 node? That is the question. Well, we don't have a lot of people in the chat room there, but we will say hello to them. How you doing, Brent? Yo, nice to see you. And is here as usual. Hello, hello. And Jim. I'll bet you anything that there's another 20, 30 people back there that are just waiting for me to say, hey, come on back on, say hello. We need a roll call. Now, all right, so everyone's probably thinking, oh, Ernie, you gonna make a trade here? Yeah, they all come. Hey, doing streams. Haven't seen you for a while. Hans is there. Adam, nice to see you. Arts Crafts, there's a new name, new face. How you doing? And Jeffrey saying he's watching a 20 wide at 36.90. So I know that there are people within the service that have taken trades today. And Pete is saying, if the trade is a loser, do you just let it expire? Yes, as a matter of fact, I do. Now, the key to that, Pete, is that you need to find a level of risk that you're comfortable with doing that and letting it go to 100%. And that's really how you find out what is your max position size. That's the position size that you can let it go to 100% and feel like, okay, I put on an appropriate amount of risk. It's not going to bother me. And it won't bother me if I have, say, 4 or 5 or 6 of these in a row. Well, it kind of bothers you, but you don't want to lose 5 or 6 times in a row. However, you want your risk set in such a way that under normal conditions or even poor performance, the worst that's going to happen is you're going to go sideways or just slightly down. Now, in the last 100 trades, my drawdown's only been 3%. And it was in one of those, just such of those positions where things went sideways and a lot of volatility. And in fact, it was during a period like what we're seeing now in a bear market rally. It was very difficult to navigate because of these intraday reversals. So I tend to move aside of that. Now, some people that are traders out there might think, man, that's kind of wussy, Ernie. I mean, shouldn't you be like in the fire and going after it all the time? And the answer is no. We're here to try to build wealth. And the way you build wealth is that you take very smart positions with an appropriate amount of risk, where you have a reasonable expectation, if you do this enough times, that you're going to move up. I mean, you don't want to just be in the game every day just for the sake of being in the game. You want those to be good risks. Now, right now, the way I look at these markets, these intraday reversals, that is not a good risk, because what we're trying to do is place a spread somewhere that will give us this asymmetric risk opportunity. And what that means is that we're trying to put on very, very tiny risks for potentially very large outcomes. Now, those are generally relatively lower probability trades. So, for instance, my win rate is only a little over 50%. However, it's not the win rate that's important. It's the long-term outcome, the returns that you get on a monthly and yearly basis. And I've been averaging around 6% per month, which is fantastic. But I'm doing that with super low anxiety, super low risk. And that's the key. I want to maintain that kind of capital efficiency. And that's absolutely key, capital efficiency. And that differentiates everything that we do compared to other services, where our capital efficiency is literally 20 to 40 times greater. So let me put that into perspective. That means that we use 20 to 40 times less money to make the same kind of returns that they make when they make returns. All right. So just hold on to that. Now, in order to do that, you have to be somewhat selective. Now, last year, being selective was a little easier because we didn't trade as much, because we were only trading 3 days a week. And that's all that was offered on the zero DTE front in those options, 3 days a week, Monday, Wednesday, and Friday. And I liked the cadence of that because it allowed us some time, a respite, periods in between where we could reflect on what we did and then plan for the next day. But now it's every day, Monday, Tuesday, Wednesday, Thursday, Friday. And it wouldn't surprise me if sooner or later it's going to go Saturday, Sunday as well. And soon there will be no rest. And in order to have, I think, a sound mind and sound judgment, you need some level of cadence, some rest area in there. And for us, that just means being a little bit more selective. Now, we could, if wanted to, just trade like the old way and trade Monday, Wednesday, and Friday. The only problem with that is that there's varying levels of opportunity. And we can't say that all the opportunity is always going to be on Monday, Wednesday, and Friday. It might be on Tuesday and Thursday for all we know. However, we'll raise our criteria, our standards, so to speak, so that we will find days where they're just not attractive to trade. Now, of course, if you were to ask, most day traders that need to be in the game, that's probably a no-go for them. And that's fine. That's fine. We're not in it to just be in the game all the time. We want skin in the game. That's important. But we want it in when we're going to get a huge chunk of skin back. So that's the difference. Let's see. We got, and then some people within our group may have found an opportunity, something that looks attractive to them, and so they trade. So I'm not stopping anybody from trading here. Let's see. Pete says, if the trade is okay. That question: if the trade is a loser, do you just let it expire? So let me illustrate that so that you get a real idea of what it means to let something expire. So what I'm going to do is bring forward my trade log. And I also had another study that I did that was an analysis of my trade log that I'd like to share, and I'll bring that up in a little bit. But up here you can see, here's my win rate, about 53%. My return is about 6% per month. And if you look very closely here in the returns column, you'll see that there's places where and over here in the exit really tells you where the returns are. You can see them very clearly. The zeros, those are my losses. 0, 0, 0. And if you look closely, anything that's not a zero is typically showing a higher value than the entry or the cost basis, which is the entry. So if you look at all of my losses, almost every single one, well, here's an exception right here. It looks like I get out early for whatever reason. I didn't take too much of a loss there. But almost all of my losses go to 100%. And that is because I have a level of, or a size of position size that allows me to do that. Because I'm comfortable with that loss, the bet didn't work out, and that is my risk. That's my risk management. That's it. So I don't spend all my time managing my risk. What I like to say is managing your losses. I spend all of my effort when a trade is in the right way, managing the profits. Now, one of the reasons why I do not manage that risk and allow it to go to 0% or 100% loss is that there are times when it appears that as if it were a losing trade, and then if I had just stopped out, I would have guaranteed a loss, right? But there are times where that reverses and comes back and turns into a winning trade, and that's happened several times. So I would have to say then that a lot of the wins here are actually the results of initial losses. Now, you have to kind of weigh all of this with the efforts that you're putting in, and the strategy you're running, the risk to reward, the type of asymmetry that you're employing, and where's those sweet spots, and we adjust this all the time, and so for us, putting that effort into just those trades that we need to manage profit makes the most sense. And I think that the results kind of speak for themselves, right? And you can feel totally comfortable even with a streak. Like, look at the streak from here to here. Now, there are a lot of losses in there, but if you were to evaluate the losses with the wins, you would find that there's not a lot of drawdown there either. In fact, you can see here, this column here is my drawdown. And during that period, the drawdown never got more than 2%. 2% is nothing. Generally, if you're a trader and your max drawdown during the course of a season of trading is under 10%, you're considered doing fantastic, right? So 2% is nothing. My max drawdown throughout this entire endeavor has never exceeded 3%. And we can actually see that in this chart coming up. Well, not this one. I always have to scroll up and then scroll down. I don't know why this one turned this color. Something happened here. I had it as a red because I felt like drawdown should be red. So maybe we can change that color. We'll make it red. No, that wasn't it. It's a... No? Oh, maybe it's this. I don't know. Do I know what I'm doing with Excel? I don't. Oh, I don't have it selected. Weird. Can't just select all of the data. Oh well, I'll figure that out later. But anyways, you can see right here, there's my lowest drawdown to date, and that only went to 3.17%. Now, here is some sideways action. This was actually during this area here where I went sideways. You see there's a fair amount of good winners, but then losers, winners, then losers, and good size winners, by the way. But it went basically nowhere for almost a month, maybe a little bit more than a month. But I know that this strategy has a very good expectation of future results, so I just stuck with it. As it drew down a little bit more, I decided to contract a little bit, make my trade sizes smaller, until everything kind of cleared up and continued with the same cadence and style, and also my basic criteria, and then it finally picked up again. So what happens with this strategy is that, we take what we can get, we limit our losses through this very small position size, and we expect a certain a certain distribution of returns. And as long as we stick to that plan, that's what we get. And so I fully expect that I'll probably, go sideways a little bit more here, and then eventually it will move up to the next level, and so on and so on. And in fact, that's exactly what happened last year. Now, last year was an accelerated growth pattern because we were in this mammoth bull market, and it didn't seem like no matter what you did, you made money. All right, so there were other questions. So that I'm saying, hi Ernie, what if you can't get a proper risk to reward ratio until it's late in the day? Do you pass on that trade? That's exactly right. I do pass on that trade. And as you know, and most people that are watching this show also know that I did the final hour trade as an experiment we did 100 trades. Actually, we came short of that. We did about 75, and then I kind of let it go because it didn't make a lot of sense. I think we had answered the question of that experiment, that the final hour trade near the end of the day, it didn't have the same kind of risk to reward that we needed. And I think we just took too much risk for that little effort. It was very attractive to be at the final hour and only be in the market for a short period of time. But if you don't have a good expectation to profit, and although we did well in the beginning, the first 50 trades did fantastic. The second 50 were just a drag, a real drag. And it was mostly because we couldn't find the right risk to reward most of the time, had to compromise. And when you compromise, you don't get the optimal result. See, it says, I need to string together a few good trades so I can join the service. Well, you join the service, then you'll string together trades. Goes both ways. And let's see. Rob says, that happened to me today. I closed a 15 wide 36.95 when the price was around 37.30 and looking like it was going up. Had I held on to it, it would have likely have been a 9-to-1 trade. Yep. So that's one of the reasons, Rob, why we don't close the trades and why we don't set stops, because we don't know. We have defined our risk, and it can come down and hit that risk, and then it can turn right around and then profit again. We just don't know. All we know is that we're putting on trades, putting on spreads in an area that is likely to be touched by price. And then when it is there, we'll do our best to manage that profit. Now, with that, we are expecting a certain return or a distribution of results of return. So let me just show you that. This is our return distribution. It is what's called a positive skew. It's not like a bell curve. It is a skewed bell curve where we have a lot of small losses. So we never fret the losses, and a lot of small wins that offset those losses, and then a series of medium-sized wins and outliers. And that's really what we're after here. Now, we're always working at trying to improve our small wins too, because those small wins, if we can get them just slightly better than the small losses, then overall we have a really strong system. And that's exactly what we've achieved. We do that by continually evaluating our performance and looking at what criteria that we put into action and how it results in our in the final analysis. So periodically, what I do is I keep my logs. I keep my. Let me go to the big head here so we can see. So and a very important part of trading is to keep accurate logs as well as a journal of everything that you do so that you can then use that, review that on a periodic basis. And so I did that over this weekend, where every week we have a retrospective, where that's primarily our purpose in the retrospective is to look back at the previous week, see how we did, what we did well, what we did wrong or bad, and what could be improved, and we have and set that forward as our goals for the next week. That way, we're in this continuous improvement loop. Now, as a personal trader, I also do that sort of thing, but at different periods. I'll do it weekly, but I also do it monthly. And then monthly, I feel like I've gotten enough data that I can look back at it through my logs and performance and through my journal, which is a narrative on my performance. So you have the quantitative information and then the qualitative information. You put those two together and you're trying to recognize patterns, good patterns, bad patterns, that will usually elucidate a flaw in the behavior that I have. And so the way we fix that is that we identify it. It's sort of the four-step process, right? First of all, you have to recognize that there may be a problem. And then you have to find out what the cause of that problem is, and then come up with the cessation for that problem. And that's usually in the form of a habit fixing routine or process that we go through. And so you fix it. And that might mean just changing some of your criteria. Maybe it means getting more sleep. You don't know. So it's one of those things, or one of many things. And so from that, we hope to then continuously improve on our progress. And then we test every so often. And that helps us improve our overall long-term objectives. And that is to continually grow our wealth. So that's how it works. That's exactly what this service is all about, is teaching traders how to act that way, how to act professional. And so that's what we do. Let's see, there's a question here. That's the fine tuning, managing profit. It's tough in this market with all the whipsawing and weird reactions. I agree with that. So the best advice that I can get with those whipsaw markets, a bullish market and a bearish market are super easy to trade. The hardest market to trade is a bearish market that has these weird bearish, or you would call them bear market rallies, because they're unnatural and they're usually born out of extreme anxiety. And because of that, you have unnatural price action. And so that makes it very difficult to apply most of the strategies that we do. I suppose that there's probably an ideal strategy for playing that market. I haven't found it yet. For me, the best way to play it is to kind of contract a little bit and then just absorb it, because it is a very small percentage of the time in the overall scheme of things. And it's just a matter of just getting through it and not having any real losses. Sometimes you can profit, other times you just go sideways, and that's fine by me. So that's what that's about. And of course, our overall process is always working on maintaining our sanity, our objectivity, and the level of anxiety that we have. I mean, everybody has anxiety. If you can keep that down to a manageable level, then you can make sound, clear, rational, clear-headed choices. That in of itself is a huge edge compared to most traders. I mean, most traders are just a nervous bundle of nerve. They're just all over the place. They're constantly battling these demons. So what we're trying to do is just basically eliminate those demons and take everything from an objective viewpoint. All right, let's see. Milo says he just closed a 3720 ES for a 250% profit. And he says, if it pins, my neighbors are going to hear me scream. Yeah, that's happened to me many times. You get out, you think you're doing the right thing, and you save the trade. It looks like it was going to, head for full loss, and you managed to grab a hold of a really sizable return. 250% is nice. And then you're just looking around thinking of what else you need to do, and you look back, and then the damn thing goes right back into the middle of your strategy and pins. Yeah. That's life, right? So you learn from that. Don says, looks like Ernie was right. Looks like it's heading towards the session POC at the end of the day. And another comment says, I've been learning about some of the psychology stuff used in the industry lately. There is an amazing amount of techniques the big firms employ. You know, the easiest way to control your emotions and to control the anxiety is to not put yourself into a position that would cause anxiety. Now, I know that that sounds like pie in the sky stuff. How can you possibly avoid all of that stuff? Well, you can. I mean, you can develop systems, you can develop pathways that keep you on that straight and narrow. So, for instance, when you, I mean, that's a good analogy. Let's say that you wanted to create a path through the woods to get from one side to the other side of the woods. Are you going to find that natural pathway that goes between the trees, stays on relatively level ground? Are you going to go over, boulders and rocks and streams and jagged shards and other things? No, you're going to find the best path and you want to stay on that path. So it's the same thing that we do here. We find that best path. Now, some people might say, well, that then you're compromising the potential profit. I don't think so. I think that the results speak for themselves. ZW says, hi, new here. How are you determining where to place the butterfly? That's a very good question. So the way we do that, first of all, it all starts at the beginning of the week. At the beginning of the week, I do a volumetric structural analysis using volume profile. So go back on Monday, you'll see it every Monday. I have a video out that that is a live stream, usually lasts about 10 to 15 minutes, and I do that for that week. So we take all of the annotations that I had from the previous week, wipe them clean, and then redo it. Now it's basically the same volume profile from week to week with slight minor adjustments because there has been updates in the profile because of the market activity of the previous week. However, it's mostly the same, and a lot of that information that's in the profile is not just from recent activity, but going back as much as a year and a half, maybe even 2 years. And that is because the market has a footprint. And I implore you to go to my Sunday video where I talk about the market memory, and you'll see why the market has a footprint. So once I've gotten that structural analysis, it basically gives me kind of a landscape of the market from a price level point of view. And you'll see on all my charts, like, well, I'll show you on this one here. Let's go here. Let's go to the chart. All right, you see all these horizontal lines. That is part of the structural analysis that I do. And you'll see that when I draw these lines, many of these lines are drawn weeks in advance of this price action. It just so happens that I redraw over and over again. But you'll see that new price comes in after I've drawn the lines and respects those levels. It happens over and over. It's just uncanny how well these lines actually have relevance. And that is they were drawn from data that happened a year and a half ago. I mean, let that sink in. These lines are not things that were drawn from, indicators or moving averages or trend lines that you created over the last month. No, these lines are drawn from data and events that occurred a year and a half, 2 years ago. Yet these are the lines that the market is respecting. All right, so that's how impactful this is. And I can go back and you can just, you can view it all. It's just uncanny how it applies to these areas. So these are areas of consolidation. As you can see, we trend through the lighter areas. We consolidate on the darker areas. We trend through the lighter areas, consolidate on the darker areas. We trend through the darker areas. We consolidate on the shaded areas. All right. And then as you zoom in, you start understanding that those shaded areas are actually the nodes that were developed, like I said, a year ago. Let's take a look at it. Let it redraw. All right. So you can see this shaded area right here, the T2 node is over a value node. T0 is also over a value node. T1 is on this value node, and T2 is on this value node. And then these green lines are picking off low points in the volume profile. They are significant too because they are an extreme lack of volume, or you could say a lack of volatility. The interesting thing is that these things, these lines here, they were generated from price action back here in 2020, 2 years ago. Yet price is respecting them today. Today. All right. So I'm going to finish your question, ZW. How do you determine where to place the butterfly? So once we have the structural analysis done, then each day I do a geo macroeconomic analysis, looking at economic reports, looking at the overnight action coming out of the Asian market, the European market, any overnight news, what type of momentum the market has picked up through the market, how it's entering the new market. When economic reports come out in the morning, they will generate a certain amount of energy and put it into the market. It may be bearish or bullish biased. All of that stuff you get, and it's both quantitative and qualitative data that you take and then apply and develop some kind of bias. So during that bias, I have either a bullish or a bearish bias. However, I'm not certain whether it's going to be bullish or bearish because we can't be. So I create scenarios that respect those market profile or market structural elements given that energy that's coming into the market, and create both a bearish and bullish scenario. And then once we've done that, let's zoom in, we can see that. All right, so here's an example of that right there. Once we've done that, we then can place our trades based on that kind of analysis. And the trades are just generally out of the money butterflies, they're spreads. They cover a wide range of prices, and we put it over an area where we think price is likely to move to. And we put it far enough out of the money so it gives us the kind of risk to reward that we need in order to get the kind of future expectation that we want to. Because the more asymmetry, the greater disparity between risk and reward, the greater our future expectation of profit is. And saying the greater, more it is, you would say, well, then just make it infinite, right? Then your expectation is, 1,000%. But not really. There are limits. There are sweet spots that we use and that we discover, and based on our overall temperament and ability and capacity and tolerance for risk, will tell us where to put those things. And that's all part of our continuous improvement process that I talked about earlier, where you keep your logs, you keep your journals, you take all that quantitative and qualitative information, and you use that as sort of a input to your continuous improvement process that will keep you on track. And that's basically how we choose those areas. Hopefully that answers your question. All right, so Vadim says, do you keep stats on the rate of your trades that were profitable intraday? Well, all the trades are intraday, right? So there's usually only one trade. Sometimes there's two when we're doing these static flies. But do I keep stats on the rate of your trades that were profitable? Yeah, so I keep all the stats. Let me see if I can illustrate that. And then I analyze it every which way. So I'm keeping, of course, my entry and exit, what time the trade happened or what day, the return, the risk to reward that I took on that particular trade, what was the max profit potential for that trade, what was the width of my fly, so that's per spread. So for instance, if it's a 10 wide, that means that there's two spreads in a fly, so that's actually 20 wide. A 15 would be 30 wide, a 20 would be 40 wide. and how many contracts are traded. I generally only trade one contract for the most part. Every once in a while, I add to it if I can reduce my cost basis and still keep the kind of risk to reward that I'm looking for. And so I keep track of all that, and that basic data I can extract from that the frequency of return, the return distribution, and the frequency of the type of risk that I take. And so that's what these two charts are showing me, my return distribution, looking for that positive skew with fat tails, and then my frequency of putting on these risk to rewards. So you can see that I usually go somewhere between 7 and 10. I found that the sweet spot where I make most of my money is between 7 and 8. So 1 to 7 to 1 to 8 is where I seem to flourish or seem to do best. And I did a recent study on that by analyzing all the data and breaking it down by risk level. And I can show you that right now. That would be this guy right here. So I found all the trades within these various risk levels. That's in column A. All right. And how many trades I had within each risk level, how many wins, how many losses, what was the percent winners, what was the size of my winners, what was the size of my losers, and then what was the net. And what I found was, well, at least you can see it very clearly on this chart down below, that when I took risks between 7 and 8, that was also my largest number of trades that I took. No surprise there. Not only did I have a fairly good win percentage of 62.5%, but it by far was the biggest winner. Now, it's interesting on 10 to 11, so a risk reward of 1 to 10 or 1 to 11, I had a very high win rate of 83%, but it didn't make quite as much money, but that's mostly probably because I didn't trade as many. You just don't get that many opportunities. Now, this is out of 101 trades. I'm sure that a lot of this data will change a little bit after 200 trades, but it will generally be approximately the same, at least from my experience and looking at it over the past couple of years. It should be approximately the same. It would be interesting if I could see what happens. Perhaps I should start concentrating on these 1 to 10, 1 to 11 trades a little bit more. This is the type of data that I'm looking for. All right. So, Vadim, I hope that answers your question. Oh, he has another question. Rate can be profitable in the middle of the day, but ends up a loser at the end. I don't really keep track closely, but maybe I should, about when I take the trade. Generally, I take the trade in mid to late morning. And the idea there is that I want to take it as early as I can in the day, but still avoid the majority of the volatility and get the true market direction, or at least what appears to be the true market direction for the remainder of the day. And it's not always telling me that, but more often than not that it does. So taking the trade mid to late morning seems to be the optimal time. And we've tried different things. Of course, we did the experiment on the late day trades, and we found that that's suboptimal. Maybe an experiment might be that where we try trades that are from 12 to 2 and see if that works out better. And so I'm certainly open to that type of experimentation within the service to see if that's something that works for us. All right. Adam, do you mean the trades that were profitable at some point during the day, but maybe profit wasn't taken? That can happen too. So if you decide not to take a profit, hoping that it will go further, but that really comes down to your execution of your profit management plan, right? So I have this sort of boxing method that I use for my profit management, and it varies a little bit from one point of the day to the next. As I progress through the day, say from 11 to 1 to 2 to 3, the parameters around that boxing changes. It usually gets a little tighter because the gamma risk has increased during the day, and the rate at which premium is decaying is also increasing. So I have to take that into account. So what you're asking really is, well, do I keep track of my ability to follow my plan? And that comes from my logging and my journaling. And so in my journaling, I'm looking at, how I actually followed my plan, whether I followed my plan, and taking that qualitative information, then looking for patterns that I can correlate to my results. And then if I see an issue where I'm off on that, then I take action to try to remedy that in my actual trading. All right. Your study shows if you're trading a small account and using smaller widths, it might make sense to wait a little later. All right, so that's a different study. And again, let me go back to the big head here. And I'll bring up that study to show what you're seeing. Some of it works, some of it doesn't, because I have been doing some research on that and really crunching the numbers on what works, what doesn't. And what I'm finding in terms, I did some research on widths as well as the risk to reward. And I found that my best trades are actually between certain widths of trades. The number of strikes that I use for the width of the butterfly. And it goes a little contrary to that study that you're referring to. And the study you're referring to is, let's see, right here. This study. So this study suggests that narrow widths work better or don't work very well early in the day, that you have to wait till later in the day, like a 10 wide and a 15 wide even. But the 20 wide seems to pick up a little better. And overall, the profit that you get versus the cost of the trade seems to favor the wider trade. The problem is it's harder to get these wider trades. You have to put them further out of the money in order to get that kind of risk to reward. So there's probably a lesser probability of touch for those trades. What I found was that my optimal size was actually 15 to 20. That's where I'm making the most money. That is where I'm making the most money. 25, I didn't do so well. Let's see, do I have that data? Where is it? I'm almost positive I put that down here somewhere. Well, maybe I'll do that again. I did such a study. I just don't know where it is right now. Let's see. Is it in the recents? No. No. Well, I'll find it. But I did a study that looked at the width of the trade, and what I was just referring to there. I guess I wasn't showing that in here. About the width of the trade, and this is the study that you were probably referring to. Yeah, I gotta scroll it up and scroll it down to get the charts to show up. That is showing clearly that 10 wide trades don't really perform until you get later on in the day. 15 wide trades start a little earlier, and 20 start a little earlier than that, and 25 earlier than that, and 30 and 35 show that same trend. But the reality now, from that, you can conclude that, hey, it looks like earlier in the day, you should just take wider trades. You'll be all set. You'll make money faster. But that's not necessarily the case. Even though the data shows that, that's not what it's like in practice. And so when I use real world data of my actual trades, I find that my best trades taken around 11 o'clock, 11:30. So this seems to be the sweet spot right in here, like right there, is the 15 and 20 wide. The 20 wide in particular. 15 did a lot of great profit too. I wish I could find that report. Where did I put that? Well, I'll redo it and bring it back and show you. Right, but that is the fact that man, where is that? I did that. Where did I put it? It's not this one. No, it's not on the simulation. I don't believe so. No, and it's not on this one. Man, I can't believe I can't find it. But I will. I'll do it by time, and you'll find. Well, this is a pretty good correlation. If you were to take all of these trades and take a look at where I'm winning most, they tend to be with those widths that I was talking about, the 15 to 20 wide. They seem to be the best, the sweet spot. I would say 15 to 20 wide, giving me a 7 to 8 risk to reward. All right, that is the sweet spot. So you learn a lot when you start plugging in the data, and then just as equally as important, correlating it with your logs and your journals, because that makes a big difference. But I'm going to generate that report again, and we'll see how that. We'll see the hard and fast numbers. So hopefully that answers people's questions. Let's see what's happening with the market, by the way. Not a whole lot. Just going back and forth, back and forth. We need a big dump. That's what we want, big dump. See, this is what we call a distribution day, where you have nodes that seem to be equally distributed. You know, we deposited some down here, some up here, some up here, but it looks like right here is going to be the end of day. Volume is growing fast. Let's go to a 1 minute. So originally I had called for 3740 as being the end of the day. Let's see. Don says, I don't think there is some optimal time component involved. Here's the market. The earlier you put on the trade, you are giving up time and future knowledge of the market you could have had. I think that there are optimal times, but the only way to really confirm that is to do a study, a concentrated study of taking trades at various times. Now, the problem is that you got to make sure you have enough data in order to validate your conclusions, because otherwise then they become just anecdotal. And we're getting a lot of volatility in the market right now, in the aftermarket. It's going up and down, up and down. Look at that. Big range. Went from 37.23 all the way up to 38. So there's almost a 20-point range in just the last minute. Yeah, there's a lot of big forces behind this. They want the market to go somewhere. So getting back to that optimal time, that's another study that we could probably do. And there are two ways we could do the study. We could do just measurements of where fictitious trades are at any point in time, and see what the market is pricing for those trades. The other way, I mean, that's one level of data. The other way is then the application of our strategy at those various times, and see how that compares to just the non-active management part of it. Just the raw data. So we'll do that. We will definitely do that as well. Does TradingView show the ES close price anywhere? No, but you can get the ES close price by going to CME fixing price. Just Google that. That's the Chicago Mercantile Exchange fixing price. And they publish it right after the market closes. As a matter of fact, I'll do that right now just to show you. So let's let us go. Oh, that's one of my websites, my blog on meditation. So we go to CME fixing price. Here it is, fixing prices for the CME group. And this will give us the actual close, the official close. So the E-mini S&P 500 closed today at 3732.87. There you go. There it is right there. All right. So we're done for today. Interesting day. One of those days that we just decide to step back for a bit. And if this was a year ago, we wouldn't be trading on Tuesday anyways, right? I mean, there can be something said for just trading on Monday, Wednesday, and Friday, quite frankly, even though the Tuesday and Thursday markets are now open. The interesting thing is that not only has the SPX, as of May, I think it was May 20th, they've gone to 5 days a week, but also the micro version of the SPX, which is called the XSP, has just recently gone to 5 days a week as well. So hopefully that micro index will be used more, at least the options, so that we can build up some liquidity in that. And then we'll have a much smaller index to trade as well, so that you can accommodate a much wider range of accounts. It will still be subject to the pattern day trader rule, that's a problem for a lot of people that are trading with small accounts. However, we have developed a technique for completely obfuscating the bad effects of getting a strike, where you will never get a strike if you follow our patterns and our strategy. All right, Don has a bookmark. That's good. All right, I'm just looking at our Discord and seeing how people are doing. Looks pretty good. People making profit, that's good. I had a busy day. I've instituted a new practice in bringing on new customers, or new members. When you join our group, as soon as you become a trial member, every trial member I meet personally. So when you're welcomed into the group and you've joined, you'll get a link from me where you can book a meeting with me for 45 minutes. I will sit down with you and get you up to speed very quickly. So it'll be the most efficient way for you to take part in this trial. I really don't know of any other service that does anything like this, and particularly for trial members. But that's the dedication I have to the members that are coming in. I want to make sure they are as efficient and ready for inclusion into the group as possible. And it's a 4-week trial, so unlike other trials that really cut them off very short and it doesn't give you a lot of time to decide, here you will actually get a full-fledged experience for 4 weeks at a very reduced rate, and no obligation. You can leave anytime you want. You don't have to go the whole 4 weeks. You can go 1 week or 3 weeks or 4 weeks. You can become a member after 1 week. You can become a member right away. But no matter what, you will get a meeting with me face to face. I will go over the entire strategy. I will talk about your experience trading and what to expect. All your expectations will be met. And it will be the most comprehensive experience that you've ever had in a service such as this, which I believe there are no other services like this. Where is the last service that you know where you were able to meet directly with the owner and operator of that service? Someone who has the kind of experience that I have, 40 years in the industry as a hedge fund manager, as a fintech executive. I was a chief architect for Sun Microsystems, where my team literally built out Wall Street. I have worked for just about every single brokerage and financial institution on the street. And I have been a trusted advisor to those people at the highest level, as well as a coach to dozens and dozens of traders. That is what you're going to get when you get into 0-DTE.com. So there you go. Join now. Links below. All right. That's about all I have to say. Where is that window? Peace to you all. I hope you all have a great evening. It's time for me to get ready and go out and walk the dog, do the trail walk with the dogs and the wife. And not necessarily in that order. I mean, wife's important too. Peace to you all. Take care. Now it's time for the music.